Employees over the age of 50 are losing an important tax break. In 2026, if you're over the age of 50, making more than $150,000, you're losing a helpful deduction contribution for your 401k catch-up provisions. This is something that Congress is forcing people into a Roth IRA, whether you like it or you don't. All right, Dee, we're talking something that came out just recently, probably within the last week or so, where the government, Congress, has implemented a new rule for next year. And what they're doing is they're taking away a helpful deduction on our taxes, because they are doing is that they are going to force anyone over the age of 50 that is contributing to your 401k, but also doing the catch up. So like for 2025, for example, everyone's allowed to contribute up to $23,500 into their 401k. If you're over 50, you get to contribute another $7,500. So 31 total if you're over 50. If you're under 50, $23,500. Next year, and we don't know what the numbers are going to be next year, but I would assume that the 23.5 is going to go to 24,500 and the 75 will go to 8. That's what they're projecting. So, but that $8,000 for next year, and that's an estimated number, is not going to be tax deductible. They are going to force you into the Roth component of your 401k, even if you even have one. Right? So that's a big issue. And actually, you know what? Let me retract that. It's not a big issue. I know we're losing deductibility, and if you really put pen to paper, like you're losing you're going to pay $2,000 extra in taxes to save that money. You're not going to get the deduction. You're not going to get $2,000 back, right? That's essentially what it equates to.
Right.
Maybe a little bit less. I'm rounding, but that's all that's happening. Now, a lot of people are like, oh, you're losing an important tax break. And yeah, the government needs money, and they're thinking of creative ways at this point to get that money. And I think I get it. It's, who doesn't like a tax deductible, contribution?
Right.
But I've always said, and, Derek, when we were teaching our educational classes, like, it's okay to have 3 buckets of money walking into retirement: cash, tax deferred, and tax free. The government is forcing now the 3rd bucket if you don't have it. They're forcing that tax free bucket. And I don't see a problem with it. You got to pay the taxes at some point. Mm-hmm. You're paying it up front. But now what you have is a tax free bucket of money for retirement when you retire.
Right.
So,
yeah, I think you hit the nail on the head right there. I'm a huge proponent of tax status diversification in retirement. And these are kind of just things that you see throughout your career. You see the number 50 out there, and you think it's a ways away. And Tony and I are looking at each other like, dang, that's not too far away now.
A couple years away.
But it's I think it is so important, especially when you get a financial plan a little bit earlier on. We've been told basically our whole life that we have to jam as much money as possible into, tax deferred vehicles like your IRA, like your 401k. But in our careers, we've been around long enough to kind of see, I don't want to say necessarily the fallout on that, but if you only save into one bucket and you have to pay taxes on everything that you pull out in the future, it does kind of limit your being able to access that money, because you have to, pay big taxes on it.
Yeah.
Whether you're buying a house or a boat or, moving or whatever the case may be, if you need, a big chunk of change and it's all in your IRA account, you're going to have some issues pulling that out.
Yeah. I mean, if all your money's in a tax deferred traditional side, I'll call it traditional side, tax deferred, guess what, man? Like, there's really not a lot of tax strategies in retirement other than maybe conversions.
Yep.
But if you now have pockets of money where you got a traditional side of the equation, you have a Roth side, you have a cash side, this is where you can start pulling from every bucket to optimize your, I guess you're like where you're going to land in your in the federal tax brackets.
Yep.
Right. You can hypothetically take maybe 60% of your money from your traditional and 20 from cash and 20 from Roth to get your lifestyle income in retirement. And by doing that, you can maneuver and keep your taxes low and efficient.
Right.
Doing that. Right. So again, why the Congress is doing this, it's essentially they need the money. Let's face it, they're going broke and they're constantly deficit spending. So that's why they're doing this. But you know what? I mean, I know they're going to spin it, be like, hey, everyone needs a Roth IRA and tax-free growth, and spinning the positive, which I'm on board for. I mean, I get it. The only thing I would say, because I've said this in the past, is getting the most deductibility while you're working is really what you want to do, because those are your high earning years towards the end, 50 and above, age 50 and above. But it's nice to get that tax deductibility, because by the time you retire, the money that you need to retire and live your lifestyle is probably a lot less than what you were making. So you most likely, I see most people are in a lower tax bracket, right, than when they retire than when they are working. Like it's like, oh, you're going to be in a higher one. No, I don't see that too often, actually. So I would say that is a con. I think you are losing it, but you are going to gain it back, because if that account continues to grow, you don't pay any taxes on the gains.
Yep,
right.
Sure. So something to also keep in mind are the IRMA cliffs for the Medicare surcharges. So
what did you just say?
The IRL. So that's like the Medicare stuff, right? So the higher income that you have, the more that you could potentially pay in Medicare
costs.
Yep. So that's something, that's another tax planning thing to keep in mind, especially in retirement. So I completely agree with Tony, but also sometimes at the beginning of retirement, maybe you take like a big trip, or maybe you're moving, or maybe you have one tax year that's actually bigger than your one of your final years working. So it's important to keep that in mind. If you're taking, again, big chunks of money out of your qualified plans, that could cause your healthcare costs to go up as well.
Yeah, I mean, man, can you what a mess. I'm serious. Like, if you think about it, like now it's not, I don't think it's my problem, nor is it the employee's problem, but it's like the people that run the 401k, like they have to now, they have to make sure that the plans have a Roth IRA, but now they have to like calculate the thresholds as you get there, be like, hey, everything's traditional. Oh, the light switch, flipped on, and now you got to dump it over to the Roth. Like, there has to be, like, I'm just thinking some weird nerdy stuff, and it's like the algorithms to like catch the people before, as you tip into that Roth bucket, that it's like, man, what a way to make it I mean, our tax code is so goddamn complicated, man. Like they created a new rule this year where you got the super catch up, and it's from age 60 to 63. That you can, rather than $7,500 contributions, you can make $11,250. What if you're 64 or 5? Like,
who keeps track of all this stuff?
Who's doing this? Like, why?
Tony, that was my main takeaway from the Secure Act, the 2.0. So to be clear, this was all the way back in 2022.
I was going to say it. Shit show, man.
That is
constantly.
Literally, when I was looking at all this stuff yesterday, that was my plan to say those exact words. This is a shit show from top to bottom, and this is the literal definition. Like, who's keeping track of all this stuff? So, like,
obviously we need to, but still, like, God.
So this is obviously a Democratic plan, signed into law by Biden. And you can kind of see the fingerprints of like a, socialist type of, spin on these things. So basically, they let businesses match your student loan payments, so that's good. But who keeps track of that? But even more, there's a savers match. So basically, if you're a single filer and you make under $20,000, or a married filing jointly and you make under $40,000, the federal government is going to put money into your 401k up to $2,000.
Okay, so it's like a pseudo employer safe harbor, because typically some employers offer the safe harbor, whether they're going to contribute for you the percentage of your wage, right? 3% sometimes, or things like that. Now the government's kicking in money too.
Yeah, so potentially you could have, yourself, your employer, and the government all kicking into your 401k plan. Like
but you got to be making $40,000 as a married couple. So I mean,
under that.
under 40.
So exactly. So if you're making $40,000 total as a married couple, are you really, saving, 10% of that?
Yeah,
the 401k plan.
Yeah, I guess that's good. I mean, that's if that's your full-time wage, that's a problem. If that's a side hustle,
yeah,
not too bad then, right? If you're retired, have a small, like a side job, a part-time job.
Yeah,
that could be something to think about.
What needs to be in stuff like this is like education, right? So like I am in this business. I had no idea about automatic enrollment now, that basically, if you're not a small business, you have to automatically enroll all of your employees, which in theory is a good thing. But are they going to take advantage of it? Do they even know about it? Do they even know about, how it works? These are the things that people need to know. It's not just passing this just complicated and lengthy legislation that, it might sound good in theory, but how many people is it going to help?
Yeah, and how many? It's the complications behind it. I mean,
exactly.
I just can't get over it. But at the end of the day, what is really happening, and we'll sum this up again, is that the government needs money, and they're going to force you, the savers, essentially it's those dual income households, that high salary employee. People that are working or have side income, they're forcing you to pay your taxes up front, but again, the pro is that you get that on the back end.
Yep.
But I can spin it the other way and say, well, when I'm working, that's when I'm making the most money. So now they are screwing me.
Right.
So
because you got to pay more taxes.
Yeah, I got to pay more taxes now. And when I'm retirement, I'm probably going to be in a lower bracket typically. Mm-hmm. And so again, it's just one of those small things. And it sounds like, we're making a huge big deal out of this, but at the end of the day, it's $2,000. If the deductibility, maybe just under $2,000 of deductibility that we're losing.
Yeah. $2,000 in taxes, but also I think a good action item is to, if you're making over that threshold, to check your employee plan to make sure that you have the ability to contribute to a Roth.
Right. Big deal.
Because if you don't, you should definitely talk to, HR or whoever's in charge to get that added.
You need to start asking them now, because
right.
It is not easy. Usually you can't, like most plans are done annually, right. So, like it is updated annually to do this. And a lot of employers have this, right? Mm-hmm. Like if they have a 401k plan, they have turned on the light switch to do traditional and Roth contributions. It's pretty common, but there might be those smaller plans that don't offer.
Yeah, like the older plans.
Right. So, well, let's wrap this up, man. It's a short one because it's just it's a very single basic topic. It's a shit show. And, if you have any questions, drop them in the comments. Reach out to us, info@swpconnect.com. If you have additional questions on this, we can help you navigate through it. Anything else you want to add there, D?
Nope, and get a long-term tax strategy, not just a single-year strategy.
That's right.
So we'll talk to you guys next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.